are officially live on YouTube for the Tuesday edition of the Not Your Average Investor Show. Today, we are talking about a soft landing, like they are speaking about all over the place. What does it mean? What does it mean for real estate investors? And what are other opinions out there, since we like to do Not Your Average Insights? I'm your host, Pablo Gonzalez. With me, as always, the man I like to call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And with us, as always, our amazing community manager, handling anything that you need in the chat, making you feel welcome, making you feel supported. We call her MTM because she brings us the moments that matter, and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everyone.
And it is good to have the community in the house. You know, if you're joining us for the first time, we've got this course about rental property investing that you can find at notyouraverageguide.com. GC, you want to tell them a little bit about it?
Yeah, I think this is a wonderful course. If you're a newer investor and wondering what it takes to really kind of add that first rental property to your portfolio, how do you break away from what everybody else says is the normal way of investing? Get out of stocks and bonds, get into something along the lines of direct ownership of an asset, which is rental property investing. This is the course for you. It's going to help you do that, go from 0 to 1 property. But if you are an investor who has maybe 3 or 5 or maybe 10 properties under your belt, you've seen how well this asset class performs and you want more of it. You want to see what it's like to get to 10, 20, 30, 100 rental properties in your portfolio. This course is also for you. This has been the combined efforts of our whole team here that you see, and then over 100 other folks at JWB. We put our combined effort, experience into this course, and I think you're really going to love it. So go ahead and enroll in the course. Go to notyouraverageguide.com. I know you're going to love it.
We know you're going to love it. We put a lot of love into that course. We made it as short as possible, packed with as much value as possible, and with as much good times as possible, because it's me and GC explaining things. And the other benefit of that course is once you show up, you no longer have the knowledge gap that might make you too nervous to just interact in the community. Then you get to show up, check in, and be part of what, GC?
The roll call, baby.
The roll call, baby. We got Lita Song kicking us off today. Lita's becoming quite the regular from Minnesota.
Fantastic. Good to see you, Lita.
Good to have you, Lita. We got the ringmaster in the house.
Andrew Barnhill.
We got the early bird in the house from Columbus, Ohio.
Dean Curry.
We got the MVP in the house.
Mr. Lee Bishop.
We got the touchdown maker.
Shannon Baker.
We got our usual leadoff hitter batting 5th or 6th today.
John Henning.
We got Milady.
Jack Chatta.
Jack Chatta.
This is great, by the way. I'm not looking at any of the chats. I'm just going straight off of what I know. It's just flowing.
Yeah, this is it. This is it. We got Chris Lee from Fernandina Beach. We need to come up with one for Chris. We got Big Papa in the house. We love it when he calls him Big Papa.
Bobs, how are you? Good to see you, my man.
We got our favorite bilingual check-in with a Feliz Martes, damas y caballeros.
Bill Shields.
Our regulars, the second family of the Not Your Average Investor Show community from Marietta, California, Gary and Rosalind Riley.
We regard you.
We got the first family of the Not Your Average Investor Show back to back here. The patriarch and the matriarch, Ken and Carolyn Moline. We salute you. We got the fairy godmother in the house checking in with us.
Jen Filson.
Jen Filson from Monterey. We got Layla Powell, teammate Layla Powell, house checking in.
JWB in the house.
JWB in the house. We got a couple more here. Hold on. I wanted to get through. Like everybody checked in early this time. They learned it. Oh, our favorite name to pronounce. Aaron O'Neill.
Into the lights.
And checking in from the doctor's office in Denver. Billy Green, the mountain man.
The doctor can wait. We are talking about a soft landing here.
I love it, man. I got to go out to he does live out in the mountains of Colorado. He is looking out onto a beautiful mountain landscape. He's got like hummingbirds at his house. It was a beautiful, beautiful environment. I'm really glad I got to go visit. Who else we got in here? All right. I think we got Eddie Harris from Atlanta checking in. All right, let's kick it off, GC. So interesting that one of the headlines has been this idea that this has been the most predicted recession ever. We're gonna talk about that in a second. But as a consequence of that, we've been beating the drum for like a year and a half about this like upcoming recession. And it seems like there's more and more headlines, more and more tides are turning, talking that this could be that infamous soft landing that everybody always hopes for when there is a big bull market. I did a little bit of research on what that means. What does a soft landing mean and why is it happening? For one, it's that companies have slowed down in hiring. They're not really laying people off. They've slowed down in hiring. And what they're after, right? Like what the Fed is after, based on the definitions that I've seen, what classifies as a soft landing is if they can get inflation down to 2%, unemployment to stabilize somewhere between 3 and 4%, and a 2% growth of GDP year over year is the definition of a soft landing that I have found, right? So they're trying to keep those numbers in line. What do you think of that to start with, GC?
Well, those numbers that you just threw out there is like the Fed hitting a grand slam. Like the Fed having 2% inflation, unemployment at 3 to 4%, and GDP growth 2% or higher quarter after quarter. That's like perfection for the Fed. And that's like perfection for the economy. And I haven't seen perfection by the Fed or the US economy very often. So, what I would say is this term of a soft landing, you are definitely hearing more and more about this. But, the idea that the Fed would hit these numbers and that would be the definition of a soft landing, to me seems, I would think that the soft landing listen, we haven't talked about soft landings very much. It's not like in the vernacular. A lot of the terms economically that we speak of are different today than they were in the past, but this is one that we don't talk a lot about. So there's not really a definition of a soft landing in my experience. What I would say is that if the Fed can orchestrate this, if the economy complies, and we get inflation closer to 2%, which is that consumer price index measurable, if that gets closer to 2% and we are not in a recession, that would be achieving a soft landing that I think the Fed would be really happy with. A recession generally is defined as 2 consecutive quarters of negative GDP growth. So I think that data is more of kind of like perfection. And I think that many people would call it a soft landing, even if you didn't get exactly there, if the target was a little bit wider.
That reminds me of why this even came up, right? It's because the Fed is not expecting a recession because there was GDP growth, right, in the last quarter. Mm-hmm. Therefore, we can't be expecting a recession because it won't be 2 consecutive quarters of GDP growth, right? So that's kind of, to me, that's kind of how it all kind of like started bubble up. It's like, oh, wait a minute, we're not predicting next quarter a recession. Therefore, maybe we should be predicting a soft landing, is kind of how I've interpreted the rhythm of all this.
It's just the timing. Like, how much time are you giving for these predictions, right? Are we talking about right now? Or are we in a soft landing? Nobody really knows. I think you need to look a little bit farther, even for short-term investments. I think you need to be looking a little bit farther out than right now. You need to be thinking about where are we going to be 1 to 2 quarters from now, and especially for our type of asset, which is a long-term asset that wins in the long term. We could be thinking about what's happening right now and how is that going to affect the decision for where I'm going to put my dollars so that it performs better over the next 10 years rather than the next 10 months.
Got it. Okay. That makes sense, man. So in your eye, what I'm hearing is in your view, not in your eye, because your eye doesn't speak. But what I'm hearing is, for you, a soft landing essentially means, hey, if we get inflation under control, the rest of the stuff that all these other indicators can be somewhere around there, that sounds good. But if we get inflation under control without creating a recession, to you, that's a soft landing, essentially.
I think the economy, the Fed, everybody would be ecstatic if we could do that. But it's interesting. We can think about this from 2 different perspectives, right? We can think about what would be generally appreciated and welcomed as an overall economy, as a citizen of the United States, right? I think everybody would be ecstatic about that because, as citizens, we fear recession. Right? We don't want to have an excess job loss. We don't want unemployment numbers to go up. But if we're putting our investor hats on, if we're just looking from the real estate side, you could look at it a couple of different ways. And I think a soft landing would be great for real estate investors. I actually think a recession would be great for real estate investors as well. We can talk a little bit more about that.
Yeah, let's talk about that. About that. What do you mean by that, GC?
Well, so, and I want to make sure I kind of qualify this by saying that, I'm not rooting for pain in the economy. I think there are a lot of terrible things that come when people lose their job. And so I don't want to come off as I'm insensitive to that. But if I'm just looking at the dollars and cents of how real estate will perform, real estate performs quite well in recessions. In 5 of the last 6 recessions, home prices actually went up at a rate that was higher than normal in Jacksonville and in many places across the country. So in recessions, real estate actually does quite well. And the main reason that happens is because in recessions, the Fed usually wants to jumpstart the economy. And for a long time, the main tool, the only tool that they used to do that with was dropping interest rates. They would drop the federal funds rate. It happens every recession. And when you drop the federal funds rate, indirectly, that drops interest rate on mortgages for real estate. And that is the greatest lever of demand for real estate. And that's why in recessions, real estate generally does quite well. And so whether we are in a soft landing, approaching a soft landing, or if it still goes down the route of recession, either one of those would lead to lower interest rates on mortgages for real estate, which would increase demand, which would raise real estate prices.
Got it. So we are, as investors in this asset class, we are cheering for lower interest rates in the future, which will drive up demand for housing with a constant supply that is undersupplied already. So our investments and our assets are all gonna do well.
Honestly, I don't really cheer. The best thing about this asset class for me is I think we're positioned to win no matter what happens, right? Like, for example, if the Fed dropped interest rates to a large degree right now, I know real estate prices would go way up, right? But over time, that's going to normalize no matter what because of the effects of supply and demand. So here, and the reason that I love this asset class so much is because we don't have to sit on the sidelines and cheer for one or another for fear of losing, right? We're in a position of strength no matter what happens. If it is a soft landing, what would happen is that interest rates would largely come down to a slower rate over time. They would fall, but it would take longer for rates to fall. If we were to get into a recession, the Fed would take more aggressive actions and they would drop the federal funds rate, which would drop our interest rates. And you would see a spike in home prices if you held everything else constant. But overall, this doesn't change why we, who are long-term buy and hold rental property investors, invest. If you are like me and like many in our audience here, you are buying and holding for a full market cycle. And so what's happening right now or over the next 10 months or 2 years when it comes to soft landing, recession, whatnot, doesn't change the outlook. The outlook is that over time, over the next 10 to 20 years, on average, you're going to receive, call it about 4.5% home price appreciation. And it's just a matter of how we get there. Would we have higher home price increases now, and then would they smooth out over time? Or would we have less home price increases now, but it would raise at a faster rate later on? That's really the only question when it comes to soft landing, recession, interest rate for me. We know the punchline at the end of the joke, which is home price appreciation is going to do what it largely has for the last 40 years if you give it a full market cycle.
Got it. So that is for rental property investing in this asset class. Is that the same for other asset classes? How do you see that for like market, for bonds, different things like that?
Well, I think it's very different. Again, if you go out 20 years for all these asset classes, they're going to perform over the next 20 years largely how they have over the last 20 years. So if I think about this in terms of stocks, right? According to Vanguard, over the next market cycle, Vanguard expects to earn 7% return on the typical 60-40 portfolio, which is 60% stocks, 40% bonds for their clients. And that's based off what's happened over the last market cycles and what they would expect to happen over the next one. So, if you go out long enough, none of this stuff that happens on a daily basis or on a monthly basis really affects the long-term outlook. However, a stock investment or a 60-40 portfolio investment in the stock market is not the same as what an investment in single-family rental properties is long-term. Single-family rental properties has higher expected returns and higher consistency, less volatility. So, but there's a place for both. So nothing really changes long-term. In the short run, though, in the stock market, when you go into a recession, the stock market does not do well, right? If you look at the performance of the S&P 500 as you've gone into recessions over the years, that it does not perform well. The best the S&P 500 has done in a recession is a 20% loss. So you have a lot more volatility in the short run. You have a lot more potential downside risk to going into a recession if you're in the stock market. For bonds, on the other hand, again, long term, nothing's really going to change. You're going to earn, call it, I don't know, 3, 4, 5% on bonds, somewhere around there over the long haul, depending on which bond you are investing in. But in the short run, if we go into a recession, bonds will actually do better, because what happens is the Fed will drop the Fed funds rate. When the Fed drops the Fed funds rate, the interest rate on bonds will actually go down. And it depends, I guess, which angle you're looking at it. And when I say the bonds will do better, prices of bonds would actually go up. The yield on bonds would actually go down. So, in the short run, bonds and stocks face considerable volatility challenges because they are so dependent on what the Fed funds rate does. For real estate, we've seen that a huge increase in the Fed funds rate, which has led us to 7% mortgages, still has real estate performing well. And if the Fed dropped their Fed funds rate, it would only increase home prices in the short run.
Got it. Okay. Good summary, man. We got a couple of really good questions already here in the community. So Milady Jack Chada is asking, I think what's concerning is that with an investor loan, there is a negative cash flow for the first 2 years with the JWB properties. I would love to purchase 2 right now from you. To date, my mantra has been buying an alligator, aka cash flow negative property, is a no-no and very speculative. Any thoughts?
Yeah, absolutely. That cash flow concern is easy to solve. We just put more money down. So we work with clients all the time, and it might not be cash flow positive at 20% down, might not be cash flow positive at 25% down. So you put 30% down. If you want to be cash flow positive, that's the easiest problem to solve. Just put 30% down or 35% down, whatnot. So we can certainly build a portfolio to do that and accomplish that for you. I will say, though, the idea of putting 30% down or 25% down or whatnot may get you more cash flow in the short run. So you might be cash flow positive at 30% down. But it's an interesting question, because if you look over the long haul, over a 10 or a 20-year hold, your internal rate of return is actually lower, even though your cash flow is more positive when you put 30% down or 35% down. So this is the type of discussion that we love to have with clients. We actually can model this out for you and say, okay, well, what's most important right now? Is it important to get a certain amount of cash flow positive for you? Absolutely. Let's recognize that we're giving up some growth by doing that long term. Let's have that open discussion, which is most important. So, but simple answer is cash flow positive is easy to achieve. We just need to make sure that we build a portfolio around your priorities.
Yeah. And I know that that's what you all do if somebody has a question like this, they go to chatwithjwb.com, they pick out a time, and you dive deep into this, right? But let's say Jag, I'm going to make a couple of assumptions for Jag. Jag is talking about buying 2 properties, right? Which makes me think that she has enough for sure to put 30% down on one property. And maybe what she's doing is calculating, well, I have enough to put down 2 properties at 20 or 25% or something like that. Is there also a scenario where she can put down less on these properties? The properties are cash flow negative themselves in the first 2 years, but there's also other things to invest in that can increase that cash flow and kind of build a portfolio that way?
Absolutely. So we can work with clients to put a portfolio together based on the best cash flow, based on the best returns and whatnot. And sometimes we come up with excess capital that isn't enough to purchase that next property, but it's something they want to get invested with JWB. And this is where private lending comes into play. So the private lending is for accredited investors, unless the client already has a pre-existing relationship with us. And then we can do private lending. But private lending could be a great stepping stone investment as well. So Private lending is, in essence, where you make a loan to a real estate developer like JWB. That real estate developer is able to pay you interest on that loan. And then, when you are a private lender for JWB, the ability to change that loan that you made for us into your next rental property with JWB is very, very simple and easy. So it creates flexibility for you. So yeah, so absolutely. So even if for whatever reason there might not be enough, let's run the scenario that we needed to get to cash flow positive, and the way the numbers worked, that meant putting 30% down, and Jag didn't have enough for 30% down for 2 properties. We might put Jag in 1 property right now and then do private lending for the remainder, with the expectation then when some combination of events, more capital became available or interest rates came down and that became cash flow positive at 25%, then we could just switch that private loan with Jag into rental property investment, her second rental property investment with JWB.
Yeah, there you go, Jag. So, I mean, there's a couple of options, right? Which I'm sure that chatwithjwb.com, but anybody else listening that's having these kinds of debates, chatwithjwb.com. Oh, and she's using part of a 1031 exchange is what she's saying.
Fantastic. And there's a lot that we can do to set that up correctly. The portfolio of the week that we did a couple of weeks ago now, maybe it was last week, where we went through that 1031 exchange. There's a lot of things that we can work through and make sure that you're getting the full tax savings for yourself. And it's a little bit more complicated when you've got timelines with the 1031 exchange. So that's really where a vertically integrated provider who owns the assets, who can package this up for you, can really be an advantage for you, Jag. So if you're not already on the calls with our team, which it sounds like you are, this would be a great time for us to be able to help you.
Totally. All right. We got a question here from Ayaz Hanifaz, which I believe is a new name.
New name. All right. Ayaz, welcome to the party.
Yeah. We love when you pipe in for the first time. So happy to have you. Hope you make this a habit. Asking, is getting a short-term rental better than a long-term rental? I got my first long-term rental. I have no cash flow, maybe 50 to $100, depending on any repairs. I've been leasing my property for the last 4 months. I manage it myself. Are there any tax benefits for long-term rentals that can outperform or short-term rental? Thank you so much for this wonderful show.
Yes, thank you so much for the question. There was a lot there. So Pablo, you have to help me just kind of make sure I answer the questions here. But I think the bigger question is a short-term rental better than a long-term rental or vice versa? I won't say one is better than another. They're just different, right? In the short-term rental, what you're betting on is that you're going to see a higher yield each month, higher cash flow amount each month. And what you're betting is more management, more hassle, more headache, more reliance on teammates to be able to accomplish that for you. And that's the bet that you're making. And some do quite well, some do not do very well at all. There's other risks that come along with short-term rentals that you don't necessarily have to the same degree with long-term rentals. Largely, like if we go into a recession and you have a vacation rental or a short-term rental that is in an area that is largely dependent on tourism, how's it going to fare? So the bet you're making is better cash flow year one, or in the short run, more variables, and sometimes you do better, sometimes you do worse. But on the long-term side, there are tax advantages that you get for both short-term and long-term, but long-term, generally you get better tax advantages. And the main reason is because on the short-term side, there typically are additional taxes and regulations that you have to pay because it's a short-term rental, and that will depend on the area that you're investing in. But long-term, you don't have to worry about that. Long-term, you get better tax savings because you're able to use the depreciation write-off to defer the taxes that you would have to spend on. And I could talk all day about that. So if you have additional questions, my team would love to sit down with you, Ayaz, and go through those tax savings with you. And then what else? What other question? I feel like there was more there that I didn't.
That was pretty good. I mean, Ayaz did mention managing it, self-managing.
Oh yeah. Sorry to cut you off after I asked you for help. Cut you off.
No. I'm just kind of like prompting it to you, right? So the question is getting a short-term rental better than a long-term rental? I got my first long-term rental. I have no cash flow, maybe 50 to $100, depending on any repairs. I have been leasing my property for the last 4 months, manage it myself. Are there tax benefits for long-term rentals that can outperform short-term rentals? That's it.
Yeah. And I'll just throw a question out there. Feel free to just throw it in the chat and answer here, because I'm wondering if you're looking at this investment the right way, right? Most average investors look at a rental property investor, whether that's short-term or long-term, and they look at it in a myopic sense. They look at it based just on the cash flow, and that's how they would determine the success of the portfolio. And what I really challenge folks to do is to look beyond just one profit center, look at all 5 profit centers. So, there's a lot of clients, a lot of portfolios that I put together for clients where their cash flow break even 4 months into their investment. And that is success, because number one, they bought with the right team supporting it. So that it's truly passive for them, BJWB supporting it, right? A vertically integrated provider. And then year one cash flow for them is not the goal, because where they were coming from, their money was in stocks or bonds, which they were getting little to no year one cash flow anyways. So year one cash flow is not the goal. In fact, we put the portfolio together specifically to get more growth and give up year one cash flow so that we could build the best portfolio for them long term. And then, of course, they're excited about this investment, even though they're not getting year one cash flow. It's because they're earning more from all 5 profit centers than they are wherever their money was before. So I would just maybe potentially challenge you to reframe how you're looking at this investment. You may have a really wonderful investment, even though it's not producing positive cash flow. Although it does sound like you're self-managing, which usually is not a lot of fun. So, maybe look to have somebody be able to help you out with that. JWB, if you're here locally in Jacksonville, your property is locally in Jacksonville, we'd love to help you out with that. But probably just reframing and thinking about how you're at this investment, you might be a lot happier than it sounds like you are, even though you're not earning positive cash flow right now.
All right, there you go. Ayaz just puts in that he's in Jacksonville and that this helped him a lot. And I think I have more questions. I will have to schedule some time with your team. I agree on the thought process needs to be changed. Good stuff. This is what the show's for.
Cool.
All right. Talking about this soft landing thing, right? So to recap, a soft landing or recession bodes well for rental properties. Recession does not bode well for the market, for the stock market. And it almost feels like, in general, the message that we do talk a lot about is the fact that this is a much more consistent asset. It's much more like sleep well at night when you have a good team managing this thing, and it's more consistent, right? So I think that's a ongoing theme. But if we are going to stick with this soft landing scenario, right? If this soft landing succeeds, success means slow growth period for the economy, right? That's what that is. If the Fed gets an A+ on the report card, that's what they're doing. The worst case scenario would be calling victory too soon, aka stopping the interest rate hikes or whatever other measures that they're taking, and that could send us into another high inflationary period or something like that. And the reasons why this would endure in this like slow cycle, from what I've read, is if productivity increases, aka we're able to bring in, we're able to do more with less, which I think bodes well to the era that we're in, right? Like this era of AI, of like companies having laid a bunch of people off already. Now AI comes in and these people can do more. And or the other thing that the article mentioned was finding more laborers via immigration, which to me feels like a very muddled path given the political climate that we're in, an election coming up. So let's talk about slow growth period, right? Let's say we are going to be in a slow growth period. Where would you want to have your money if it's a slow growth period? Like what a slow growth period means to you as an investor?
Either soft landing or recession. I don't want to have my money in traditional assets. I don't want to have my money in stocks and bonds, right? I want to have my money in hard assets, and especially hard assets that can get leverage, because the interest rates that we're seeing right now are higher than everybody expects them to be at some period over the next, call it 2 years, 3 years. I don't know anybody out there who's expecting interest rates to stay this high. Everybody understands this is in relation to our inflation number being so high. And hard assets have less volatility typically. And when you can couple that with the ability to use leverage to acquire these hard assets, and you see that interest rates in the future will go down, that generally means that the value of the hard asset that is backing it goes up. So I want to be holding hard assets, especially those that have the ability to get leverage when I see interest rates going down on the horizon.
Yeah. So to tap that into the language that we're using, right? If it's going to be a slow growth period, you are, and it's a sensitive equation, right? Like this this soft landing is a very narrow landing strip. Like you're landing on an aircraft carrier here in the middle of the ocean. And what you're essentially saying is that based on how sensitive it is, you want to be in a less volatile situation. So when it comes to paper assets and highly liquid things like stocks, you're not crazy about that. And then when you're thinking about hard assets, right? Because Lita's putting in, how about gold and silver? Ayaz is asking, how about bonds? The benefit comes with being able to do it with leverage, right? Because even though interest rates are high right now, you can get leverage on the asset. And when interest rates come back down, you're able to refinance out of that. And in a engineered slow growth period, you've engineered a way to have extra growth because of the leverage that you've gotten, even if everything goes right for the Fed. It's kind of what I heard.
Yeah. Throwing that refinance opportunity on there is just sprinkling additional return opportunity onto the equation there. I mean, it's just very clear that when interest rates go down, I would ask everybody to think about this, right? Everybody a year ago was predicting a real estate crash. We did not predict that on the show. We said that the market was going to normalize, which is what's happened. But outside of this show, everybody that I read or talked to said that there was going to be a real estate crash. It was just to what degree was there going to be a real estate crash? And the reason that they said that was going to happen was because interest rates were going to go way up because the Fed said they were willing to raise interest rates to whatever they needed to in order to stop inflation. Well, the Fed has raised interest rates to whatever they have needed to quell inflation. So they got that part right. But real estate prices are still up year over year in Jacksonville and in many parts of the country too. So this crash never happened. So what do we all think would happen to real estate prices if the Fed hadn't raised interest rates as much as they have over the past year and a half? I mean, if the Fed did not raise it over 5%, what would home values be? They would be much higher. So where we talked about how when the Fed lowering interest rates at the onset of the pandemic, and how in addition to QE, where they basically injected a lot of money into the economy, how that brought forward demand and increased home prices and home sales because of their actions. What we're seeing now is the opposite. By the Fed raising the Fed funds rate as much as they have, and by our interest rates going way higher, the Fed is temporarily and artificially quelling demand in the housing market, which they need to do to get inflation down. But they're not going to do that forever. So if you're thinking about when's the right time to buy an asset, and you think that lowering interest rates would increase the value of real estate, then now's a great time to acquire, because right now the Fed is doing the opposite of what they did before in the onset of the pandemic. And at the onset of the pandemic, we had a supply shortage. They brought demand forward by lowering interest rates, and home values have gone up 50% in the last 3 years. I'm not saying that's going to happen over the next 3 years, but what I feel really confident about happening is as the Fed lowers interest rates, you're going to see a huge correlation to home values going up.
Yeah, that makes a lot of sense. And I guess beyond that statement is there a correlation to that to other hard assets, right? Like if we're asking what about gold and silver right now, it feels like there's just less upside.
Less upside for sure. And gold and silver are more emotional assets to invest in. When people are not feeling good about the overall economy, there's usually a rush to gold and to silver. And so that's where the value of those assets go up. So in hard times, people rush to gold and silver, more of an emotional thing. So less upside and it's just less hard. There's less fundamentals to follow as to why people go to gold and silver. So it's hard to know where that would be.
All right. Got it. So we've talked about what it takes for a soft landing and to stay there and what it all means. Let's poke the bear a little bit, right? So one of the headlines that we read was that this is going to be the most predicted recession ever, right? And where that came from was there's these conference boards monthly index of leading economic indicators. And it's these 10 different indicators across the board, such as like permits for future homes, stock prices, upcoming orders, and like inventory, supply chain issues, stuff like that. The 10 indicators that all are leading indicators to recession or not recession, right? Like if they're down, the more they're down, the more likely it is that there's a recession. These 10 indicators have all been down since April of last year for 16 months in a row, right? So this is why everybody's predicting it. On top of that, the other thing that people talk about is the yield curve inversion. That is another huge indicator of recession coming. That's happened, right? The yield curve has been inverted. And then on top of that, it's the last and the final kind of like telltale thing is GDP falls 2 quarters in a row, then recession. And that to me is like the one thing that has reversed, right? Like there's been GDP growth this last quarter. And since this is what we do, we like to use data and perspective on the show. I think it behooves us to ask the question of, are the headlines coming from, you got one piece of data, GDP stopped falling, and now people are saying, okay, no more recessions coming, we're headed for a soft landing, when it's flying in the face of all these other economic indicators that have long told us that this means recession in the future. We'd have to essentially say the context around this has changed so much that these indicators really don't matter that much anymore. Like all of these things. What are your takes? Like, do you think that we're here for a soft landing? Are you still thinking recession? What's your take?
I'm still thinking recession.
Okay.
I think that everybody is inclined to look at the positive and have rosy colored glasses of what's going on in the economy and in the stock market. And that's how we are. And unfortunately, that's how a lot of people make money when it comes to the stock market as well. And so there is an inclination to look with rosy colored glasses. And, I may be wrong here, but I still have a healthy amount of concern for the overall economy because those metrics mean something. And it's certainly possible for one of them to be off or two of them to be off and for it to be a false positive. But all of those metrics and the metrics that usually portend some negative effects in the economy, they're all screaming red. So I still am concerned about the overall economy. And I think that there's just this rosy colored glasses effect. So what do I do about it? I put myself in a position to win no matter what happens. And that's why I love rental properties. That's why I love hard assets. But and I may be wrong here. I'm happy to be wrong, but I still think there's a lot of pain to happen in the economy. I think, as a citizen, I hope for a soft landing and I hope that there's not a recession, but I am preparing myself that there still is one.
You may be wrong, but you have some pretty good company, right? Like we teased it in the description of the show. This guy, Michael Burry, who is the one of the main characters in The Big Short, right? The one that was played by Christian Bale. He who famously shorted the housing market in 2008 and everybody was calling him crazy. He has put 1.6 billion of his managed assets into short positions on the stock market, namely shorting the S&P 500 and shorting the NASDAQ. And this guy believes that this is going to happen by end of 2023. And he's a guy that's isn't 100% right all the time, but obviously somebody that is not an average investor.
No.
And he's putting a lot of money behind it, man.
I haven't read that article yet, but I love that movie, by the way. It's one of my favorites.
It's a great movie.
Of all time. It's a great movie. I mean, listen, the guy's been through it before. He's seen it. He understands how to read the metrics. One of the simple metrics is the price to earnings ratio. And if you look over time, the price of stocks is known to be inflated when their earnings do not support the price. And it's just, you see over time. And after the PE ratios are higher than what the norms are, there usually is a correction in the stock market. And PE ratios are much higher than they should be. I think last I checked, they're like 20 or 22 in the S&P 500. Historical norms put it about 13 to 15 times. So that's a lot. And so, you don't have to be as smart and as experienced as Michael Burry to conclude that we're not out of the woods here yet. So I'm hopeful that we can negotiate a soft landing because that would be fine for real estate. That would be great for real estate, and that'd be better for overall citizens. Less disruption is better. But I'm not in that camp yet. I'm not there yet.
Yeah, it could be the PE ratios. It could be Drew's talking about the yield curve again being inverted, right? Like it could be any of those other 10 economic indicators. It seems real early to call the victory parade, right? And definitely something to be accounting for. Jen Filson has a question that I think is pretty pressing. If we're talking about that, there's still a good likelihood of recession. She's asking, question for Gregg about mortgages on properties. Please remind us what happened during the Great Recession to his 40 properties and how he managed getting through it. Should we be overly concerned about making the mortgage payments on our properties if we're working with JWB and there's a recession?
Great question. The way that I got through the Great Recession as a 23, 24-year-old neophyte who had a lot of high interest debt on my rental properties and had never been through something like this before. The way that I got through it is because I invested based on the fundamentals. I bought assets that paid for themselves every single month. And guess what? Those rents, even through the Great Recession, rents stayed strong. And so it wasn't a big deal to me as far as what home values did in the Great Recession, because I was investing for the long haul and I bought assets that paid for themselves every single month. So you're doing all of that when you invest with JWB. So you're in a great spot, even if I'm way off and that home values would go down in the future. I've lived that too. And that's why this asset is so attractive, is because it's risk mitigated, because you're investing in an asset that pays for itself because of rents. And how do you know that rents are going to stay strong? It's based on the market that you're investing in. And that's why you're choosing Jacksonville to invest in, which is a market that has 1.6 million people here and 4 Fortune 500 companies and tons of other economic drivers like the port, Amazon, shipping, logistics, hospital system, all that good stuff. So that stuff is there to support the rents. That's what mitigates your risk, even in unforeseen downturn, like I experienced.
Great explanation. I think short explanation is, if you have the fundamentals in, rents at the end of the day are the reason that you pay your mortgage, and rents tend to continue to go up during these times. The workforce housing stock that you invested in and JWB investors invest in is a really, really resilient housing stock as well, where people that are in that class for renting, there's always a demand there because it's undersupplied, and people that hit hard times renting in like luxury condos or whatever go down to there during hard times, right? So it's like a resilient housing stock, which keeps rents constant, and therefore you're able to play the long-term game, right?
Absolutely.
All right.
I was going back to the GDP data. I just pull it up here on the other side. Just to clarify, right? We've had GDP growth ever since September 2022.
Okay.
Right? Yeah, we've had 3.2%, and that at September 2.6, 2%, 2.4%, and that's gone back, September, December, March, June. So the quarters of GDP growth. So, we did have 2 consecutive quarters of negative GDP growth at the end of from middle to fall of 2022. And that was the big question of like, does that mean that we were in a recession or whatnot? Nobody really knows what that was, if we call it a recession or not, but this is why, it's not, if we could just get inflation down and limit the collateral damage to everywhere else, call it limit collateral damage to GDP growth, limit collateral damage to unemployment, the Fed would be super ecstatic. And I think for all of us overall as citizens, that would be a great thing, because there would be less disruption to everybody's daily lives.
Okay. Good stuff. Yeah. Thanks for that clarification. 2 more questions here. Ken Moline, patriarch of the first family. First of all, he had asked, what was the movie that we talked about, Ken? It's called The Big Short. It's a Michael Lewis book, great movie, really, really, really good stuff. All about the housing crash and a couple of people that shorted it before it happened, and how not average they had to be in order to do it, to be perfectly honest. So Ken is also asking, is there any way in the private lending sector to stipulate a minimum term of 1 year? Our first experience in PL was investing $45K in a property last December, then having the loan repaid in April. Our earnings did not even cover our $800 closing cost.
Oh, really interested. When you do private loan with JWB, you don't have a closing cost associated. So I'd be really interested about how you have those closing costs, Ken. But no, so in order to do what you're asking, Ken, there would have to be a prepayment penalty that JWB would have to incur in order to ensure that there was a minimum amount of interest that you'd earn. It's just not something that works for our business model. But the way that we create this so that it's not a concern for you is we're pretty good at reinvesting those funds for you. So if we do happen to pay you off way early, which for many investors is a positive thing, they like to get paid back early rather than later, we try our very best to line you up for that next investment within a short amount of time and to limit the disruption. But yeah, there's no closing costs on the JWB side. There may be wiring fees that you had, things of that nature. So Ken, would love to get more clarity on that. If you remove the closing cost expense out of the equation, I would imagine that there's not really a downside for you to get paid back early and then put it into another investment. That's the way we build it.
Cool. And then last question from Jag. At present, are you seeing a significant slowdown in time to rent and rental increase possible?
The time to rent houses has slowed considerably since last year, because last year was and the 2 years prior was just unbelievable for demand of renting homes. And we've always had a slow and a low supply of homes. So, last year, your days on market was sub 20, a normal amount of time to go from, putting the home on the market to somebody moving in, somewhere around 40 days, maybe 50 days. And generally what that is the home goes on the market, and then it gets put under deposit by a resident, typically around the 30-day mark. And then we get to move them in usually 10 days, maybe 20 days after. So we're very much in a normal renting experience now. For many investors, though, we are basing it off of what it was a year ago. And that was, just really unrealistic. And we were very open with that. We would share the data, but I definitely said, don't hold me accountable to this because this is not normal. So we're back to a normal renting market. The rent increases are lower than what we saw last year, because last year was, again, it was not sustainable. It was 10% rents going up year over year. That's just not normal. Historically, it's about 3.5% per year. In fact, actually, I just pulled the data for Jacksonville over the last, I believe it's the last 40 years, could be the last 35 years, but somewhere around there. On average, rent increases in Jacksonville are 3.6% per year. So that's what we're seeing about this year. And you call it that market to move in time frame, call it 40, maybe 50 days. That's where we're at. And yeah, so back to normal market.
Good perspective, GC. It's funny. I'm kind of on this tour, right? Like I was in New York last week. I'm in Denver this week. So I'm touching a lot of different parts of the ecosystem on the side of my own business outside of JWB, and also meeting with JWB, not your average investors, right? But the sense that I get is that there's this really, I've gotten into 3 different conversations where people are really lamenting that they're not living the life that they were living in end of 2020 and mid 2021, because the market was so good for everybody and everybody was making so much money and all the numbers, I've heard a lot of this, man, I wish we could go back to those glory days. And it's dangerous to let that recency bias of that thing was performing this way for that period. How do I chase that dragon and find that juice? And to get it back to that again, instead of just recognizing that was a period in time that's an outlier for things to normalize, or not a bad thing. And it's just a matter of, having good perspective, having good long-term strategies in order to allow you to continue to do better than, the average investor, and also be exposed to upside scenarios like what happened.
Well, let me go a little bit deeper on that, right? I think there's a lot of lamenting when it comes to maybe other assets. And maybe there's some lamenting going on for real estate too, but in other assets, you've had rides like this, right? Like in the stock market, we still have not gotten back to our gains, the highs that we had at, I think it was the end of 2021 or beginning of 2022, right? even though there's been a bull run in the stock market this year, that's still not enough to make up for the losses that were there before. So it's like there has been more reason for lamenting in other asset classes. In real estate, what's happened is it went like this, and then it's like this. Like, why are we lamenting this? I don't understand it, right? It's not like rents are going down. It's not like returns are going down. It's not like home prices are going down.
Yeah.
We went like this, and now we're like this. Like, why are we lamenting this? I don't know. So just difference there.
I'm glad I teed you up for that, because that is definitely becoming a YouTube short. All right, GC, this was a good one. GC, good job. Good job explaining everything, man. I love these. Oh yeah, Jag is saying, thank you so much. Great discussion. Thank you, Jag. Thank you for contributing so much today. That was very, very useful. Like we never take it for granted that you take an hour out of your day to show up here. And it's those questions, you asking that context, that allows us to dive into the minutia and like, is a value of, hey, I don't have to necessarily book a call with someone. I can get some guidance and then know if I need to book a call with someone. That moment of value that we can provide to you and other people, you giving us the value of answering a question a different way, and you also being able to like know when it's time to hop on a call and not hop on a call, to me is the magic of all of this, along with the community and everybody else. So just really, really grateful for those of you that show up. Shout out to the mountain man checking in from a doctor's waiting room today.
I love it. That's commitment right there.
I love it. And I love our Not Your Average Insights, GC. I like how for all of these, we're always like showing up like, all right, man, we got these headlines. And we're kind of like, before the show, we're just like, yeah, man, so this is what I'm thinking. This is what you're thinking. I'm like, this is the conversation, right? Like, I really enjoy being able to scour the internet, look at stuff that interests me, propose it for the show, and then get to pick your brain in front of everybody else. Cause it's super enlightening for me. And I think that as a guy that's always like thinking out 1,000 miles ahead, your perspective based on your experience is always super, super valuable to me. So I know it's valuable for the community, man. Good job.
Well, and right back at you, man. Your perspective, the community's perspective, that's what makes this an incredible opportunity. You know, Pablo and I don't really hash this out ahead of time. We do that on purpose so that we can show up and just be real and authentic, and, you know, sometimes disagree on things or see it from a different perspective. And, you know, I think that's what makes this special. So I'm with you, man. I love these opportunities to, you know, just to kind of let it rip and talk about how we see things, and right, wrong, or indifferent, there's value there for all of us.
Getting loose on camera. Thursday, we have a special guest coming on.
We do.
You want to talk about it, GC?
You know, we have sort of a special seat for one of our most special guests. Paul Shively of Fortune Builders will be joining us on Thursday. And the last time that Paul was here, Paul has a little bit of a following. Let's just call it that. I think it was one of our most highly attended shows. I think we had over 130 folks that came, because Paul is quite an expert. I've known Paul. He's been a very close friend of mine for 10, 15 plus years now. And he manages over $1 billion in real estate, an incredible source of knowledge. He's also a JWV client as well, and a true expert when it comes to building real estate portfolios. So we're going to break down the most common forgotten sources of capital that Paul sees, that I see, when it comes to building that portfolio for clients. And it's going to be a real treat to have Paul here. So I hope you all join us on Thursday.
Always a fun time to have Paul on. Great self-deprecating and making fun of each other sense of humor that happens when we all get together. Very much looking forward to that. GC, what do we tell people if they're joining us on Thursday? What's the one thing that they shouldn't do?
Don't be average.
See y'all Thursday.